Okay, dear students, it is time to discuss short-term investments. So bear with us. They're a little boring, but they're not that difficult to comprehend. And once we get them out of the way, we'll know where to go when we have a short-term time horizon, when we have a short-term goal. Okay? So to review, short-term investments are sometimes called short-term instruments, short-term vehicles, cash, yeah, they're not real cash, but they might as well be. Normally up to 1 year or so. Some people say 2 or even 3 years, depending on how important this money is to you. They're usually guaranteed or pretty darn close, and they're extremely liquid. There's a very low risk of losing your principal, hence, as we learned, low risk, low return. Over the long term, 2, 3, 4, maybe even 5%. But right now, what are they paying? Yeah, close to 0. Some are actually paying 0. But they're going to go up over the next few years. They've gone up a little bit as the Federal Reserve Bank does its best to normalize, that's the term you hear, the short-term investment world as we recover, still recovering from the Great Recession. A place to park your money, and as we'll see, we'll take a look at a slide about emergency funds, the emergency fund. Slide 56. There are 2 ways to earn interest on short-term investments. The first one is the way that we're used to, the stated rate of interest, the nominal rate, the named rate. This is how most people think about earning interest. You put $100 in the bank and they pay you interest on that $100, whatever it is, 1%, 2, maybe even more. But the other method is the discount method. I hate that word discount, but you see it all over in the investment world. This is a method of earning interest on a security by purchasing it at a price below its redemption value. And the difference is the interest earned. The interest accrues on the investment. That's an accounting term that you may be familiar with. It means the value of the security grows, and that's your interest. So, for example, you buy a treasury bill or corporate paper, what a silly name, we'll come back to that later, for $4,800. And in 9 months, you get back $5,000. So your interest is $200. You see that? And you don't have to wait until the day of maturity. You can turn around and sell it to somebody else. And as it gets closer and closer to the date of maturity, it will get closer to the $5,000. Does that make sense? Yeah, that's the discount basis. And that's treasury bills and other short-term vehicles that we'll take a look at. So, what are the risks? Wait a minute, Piano. You told me that these things have very low risk. Well, it depends on what kind of risk we're talking about. Are we talking about losing the money, capital losses, default? No. Your principal is safe, often guaranteed, or pretty darn close. So there's no risk of that. But there are other risks, Losing purchasing power. Yes, short-term investments barely keep up with inflation, and sometimes they don't keep up with inflation. They haven't since the Great Recession. There's a risk of lost opportunity cost. What is that? Well, you students of economics will know what that is. Unless your time horizon is very short, there are several investment alternatives, almost all of which will give you a better rate of return than a short-term investment. So that's what we call opportunity cost, lost opportunity cost. We could have had that money in something that was paying us more return. So repeat after me. Oops, come on, let's do it so we can get. There is no such thing. There is no such thing as a risk-free investment. Every investment has risks. Now, when we talk about risk, we're normally talking about risk of losing money. And yes, short-term investments have very low risk of that. But you can lose to inflation. You can lose purchasing power. And if you have a long-term time horizon, you'll lose opportunity. And we'll see that, I hope you'll see that in very clearly when we get to our next chapter on mutual funds. We'll take a look at what you would have done if you invested in one type of investment, another type of investment, and then a short-term investment, and compare the three. Okay? Slide number 58. Let's take a look at the different types of short-term investments. Well, the ones most people think about are savings accounts, passbook savings accounts. Now, some of the credit unions, the banks, they still offer a little passbook. It looks like a passport, but most don't. In fact, at a credit union, it's actually called a share account. But everyone calls them savings accounts. Checking accounts that pay interest are called negotiable order withdrawal. No one calls them that. They just call them checking accounts that pay interest. And then at banks and credit unions, you can also get a money market deposit account. Now, it's different from a money market mutual fund, but it's essentially the same idea. They copied what the mutual fund companies did, the banks and the credit unions did. They copied what the mutual fund companies did. And some of them give you check writing privileges. These are offered by banks, credit unions. They are often called demand accounts since the funds are available upon demand. They provide the highest liquidity and are usually guaranteed up to $250,000 by a government agency. The full faith and credit of the United States government. If the bank goes under, the credit union goes under, what normally happens is they go to the federal regulators and say, we goofed, we're insolvent, we made some really bad loans, or not likely that somebody ran away with the money, but it might happen. And then the federal government wraps their arms around the bank and goes to other banks and says, hey, would you like to take over this company, this bank? And the bigger banks say, ooh, sure. Or maybe they say, I really don't want that. And then you got a bit of a problem. Then they force them to take it. They say, you guys take this one or else. And they go, okay, all right. So don't worry, you won't lose your money. And if you're really worried and you have more than $250,000, just move them to separate banks, okay? Move them around. Now, if you go there and ask for cash, what's going to happen? Well, I've already made mention of that. According to the Patriot Act, they'll give you the cash. They might have to wait a day because they probably don't have it laying around the branch. But they'll also call the FBI and report a suspicious transaction. And people say it's $5,000, it's $10,000. No, it's just has to be suspicious. Figure that one out. So if you're the teller, you go to your boss and say, hey, this guy just took out $12,000, and they'll look at your account and say, oh, I better call the FBI. And they're not allowed to tell you, by the way. And I don't know what the FBI does. They'll do their little magic and see if you're a drug dealer or a terrorist. This is the Patriot Act, folks, that was pushed through 30 days after 9/11. And most people don't understand what is all involved. And I'll let you decide whether or not you think it's useful or not. Slide number 59, Series EE savings bonds. Well, these are popular gifts for newborns. They are available at banks and credit, I don't know about credit unions, but they're available through treasurydirect.gov. We'll make mention of that in a bit because that's part of your assignment. They use the discount method of payment. You buy the bond at $50, and 18 years from now or 24 years from now, you get $100 back. You don't pay any income tax on the interest until you redeem them, and they are free from state and local income taxes, and this is very cute. This is very cool. If you use them for higher education, then you don't pay any federal income taxes. That's why they're popular gifts, because people will buy them for their niece or their grandchild or whatever, and then when the child goes to college, they can redeem them and not have to pay any tax. Cool? Yeah. So ask your folks, do you remember grandmom or aunt, whatever, buying me any savings bonds? And they'll go, oh, I think there's somewhere around here. Let's go find them. And now redeem them when you go to college, okay? Cool. Slide number 60. There are also other savings bonds out there, some of which are being phased out, like the Series HH savings bonds, which are issued at face value and then pay interest twice a year. So the others, the EEs, are discount payments. You buy them at a lower rate, a lower value, and they accrue to the face value. Here, the HH you buy at the face value, and they pay interest. But they're being phased out. And then the Series I bonds are becoming more popular because they are indexed to inflation. They are guaranteed to outpace inflation, but not by much. And they pay accrued interest at the bond's maturity of 30 years. So, again, if we use them for higher education, then we don't have to pay taxes on the interest. And we never have to pay state and local taxes because the feds can't tax the states and the states can't tax the feds. We'll discuss that later on when we get to bonds. But notice that you're limited to a maximum purchase of $30,000 per year. These bonds are more popular with people who are worried about inflation. Well, inflation has not raised its ugly head for a long time. Does that mean it won't in the future? No. The only thing constant in this world is change. So inflation will come back with a vengeance someday. I don't know when, but most of the people listening to this don't remember the inflation of the late 70s and early 80s and how the Federal Reserve Bank broke the back of inflation with short-term interest rates by ratcheting up short-term interest rates to unheard of numbers, and that destroyed inflation. But people who remember it, they remember that it was pretty tough time, folks. And will it come back someday? I don't know when, but we'll see. If you're worried about inflation, take a look at Series I savings bonds. Treasury bills. Now, we already made mention of these. These are short-term obligations from the United States Treasury. They use the discount method. You buy them at a lower price than the face value, and they make their way, they accrue to the face value on the day of redemption. They typically mature 1 month, 3 month, 6 month maturities. They are generally regarded as the safest of all investments. The risk-free rate of return, right? When people ask what's the risk-free rate of return, they look at the 3-month Treasury bill typically. Remember that obligations of the United States government are free from state and local taxes. Now, these don't have the ability to use them for higher education and not pay any federal income taxes. And they can be purchased directly from the Treasury. In fact, that's your assignment, folks. Part of your assignment for Chapter 1 is to check out this website, treasurydirect.gov. Now, I'm not toting this as something you should actually use. What I am doing, and this is my goal, is to get you to nose around this investment as if you were considering to invest here. Because this is what prudent long-term investors do. They have to educate themselves. And maybe they use the help of a financial professional and they just take the recommendation. But this is an introduction to investments class, and part of what we hope you'll do is determine whether or not investing on your own is something you want to do. You obviously have some kind of interest in investing, right? And maybe you'll decide, oh no, I'll get a financial advisor to help me, or no, I can do it myself. And the cool thing is you can. If you follow the concepts and the techniques and the skills that we learn in this class, you should do well. And one of the important things is educating yourself. So we're going to take an opportunity to use this website, which is actually a very good website, folks. When the government screws up, we like to give them hell and complain about what they did. But when they do something right, we want to reward them. We want to compliment them. In fact, Mexico copied treasurydirect.gov pretty much verbatim. I talked to the project manager, who he doesn't work for the Mexican government anymore. Works for a bank now, but he said, yeah, we basically use treasurydirect.gov as our model. So check it out. Slide number 62, CDs, certificates of deposits. These are fancy savings accounts, folks. If you've never heard of them, just next time you're in your bank or credit union, just look around and you'll see a sign saying, check out our CD rates. What's the difference between these and a savings account? Well, these have to be on deposit for a certain time, 7 days, a month, 6 months. You can take your money out before the date of maturity, but yes, you're going to have a penalty for early withdrawal. So the idea is if you know you're not going to need this money for 3 months, put it in a CD and you'll get a better rate of return than if you just put it in the savings accounts. They are insured to the same $250,000 per investor per bank. And they also can be sold through brokers. These are CDs that typically pay much higher than what you'll get at your bank or credit union. Why? Well, because the bank or credit union is really jonesing for money. They need some cash. They need deposits. So they've got brokers out there that will sell, represent to their clients, CDs. Now again, they're backed by the same full faith and credit United States government, but just know that you're taking on a little bit more risk. You might get a friendly letter from a receivership authority saying, your bank is now in receivership, which means it's in default. We will be contacting you when you can get your money back. Don't worry, you'll get all your money back. It might take a little while. So that's why you get paid better. So check these out if you're so inclined. And I may or may not find an ad. I'll throw it up on the website. Careful! CDs will usually roll over automatically if you do not redeem them. What does that mean, right? Say you have a 3-month CD. There's a little window there. Maybe from 2 o'clock to 3 o'clock on Tuesday afternoon. No, they usually give you a couple weeks. And if you don't roll it, roll it into your checking account or savings account, they will start another 3-month CD. You understand, right? So yeah, and they're supposed to send you something telling you that it's going to mature. So you can tell them beforehand. You can say, you know what, I want my CD to be automatically rolled into my checking account so that they don't roll it over. Now, I have a very good friend, my wife and I have a very good friend who loves CDs. I mean, she just loves CDs. And even though she knows that I teach this stuff, and I interviewed her. So check out the interview. And she's a riot. She's a very sweet friend. But she's scared of stocks. She's scared of bonds. She likes CDs, and she continually complains that they ain't paying much these days. And I keep saying, "You're right, they're not." But someday it'll the interest. Please come. Someday interest rates will come. Well, it's happening. It's happening. Take heart. Take heart. Slide number 63. Commercial paper. What a silly name is that? Well, these are promissory notes, IOUs, short term, issued by corporations with very high credit standards. What does unsecured mean? Well, they're not tied to any asset that the corporation has. They're basically based on the full faith and credit of the corporation, and again, they're usually very large corporations. There are examples on the website in the Canvas that you'll see of corporations that have issued these IOUs. And they mature in 90 days, 180 days, 270 days. By keeping the maturity less than 1 year, they do not have to be registered with the Securities and Exchange Commission. Now, what does that mean? It just means that the process that you have to go through to create bonds is foregone. You don't have to worry about it. Now, does that mean anybody can do this? Well, not really, because if you or I tried to do this, the world would just look at us and laugh, right? You have to be a J.C. Penney's or a Chevron corporation or a Microsoft or something. You have to be a big company, and unless you're a big company, the brokers and the people in this world are just going to laugh at you. So even though they're not registered, it's sort of self-registration, right? And notice that the multiples are $100,000, right? So it's not. This is a world that you and I are not going to be a part of. Commercial paper is usually purchased by life insurance companies, money market mutual funds, banks, people with millions of dollars to invest. Maybe, a few individual investors with mega millions will invest with these. But I ask you in one of the assignments to go find a quote on a commercial paper. And you're going to find that it's not easy to do because it's just not published on the internet because most people are just not interested because they don't have that kind of money. And people who do have that kind of money have their own brokers or their own systems that they deal with. So if you go into a brokerage firm and say, I want to find a quote on commercial paper, their eyes will light up and they'll think you're a millionaire. And when they find out you're doing it for an introduction to investments class, it might not be so friendly, but they should be because you represent a potential future client. So that's commercial paper, short-term promissory notes, IOUs, issued by corporations with very high credit standings. And again, like Treasury bills and other short-term investments, they're paying very little these days, but that's going up. It's going up over the next few years. Please, I hope. Slide number 64, bankers' acceptance notes. Now, these are like commercial paper, but, these are offered by banks. Now, why would a bank do this? Well, it turns out that some companies are pretty large and do need a short-term loan, but they just don't have the stature of an IBM or a General Electric. You understand? So they really can't issue their own commercial paper. So what they do is they go to a large bank and they say, can you do it for us? That's why it's called a banker's acceptance note. They are doing it on behalf of someone else. So that entity gets to borrow money at a lower rate than if they went to the bank, but at a higher rate than what the commercial paper will pay because they're just not as big. And the typical, these are 60 days, 90 days. These are more for international transactions or just business transactions. A large company, but not that large, needs some short-term cash because they want to buy something that they need to use right away, but then they're going to turn around and sell it, and so they'll get the money back quickly. You see how it's working? It's just like us, folks, but a lot more zeros. So these are the cousins of commercial paper, and again, the minimum denomination is usually $100,000. So are you and I going to be? No, we're not going to be buying these things. Slide number 65, money market mutual funds. This is the one that I think for most investors will be happy with. And the reason is because they're just so easy. They're a mutual fund, right? But instead of investing in stocks or bonds, they pool the capital of large number of investors and use it to invest exclusively in short-term securities. Virtually all brokerage firms, all mutual fund companies offer them, and so that's why they're just so easy. They're just so convenient. They're not guaranteed, not like the savings accounts and CDs and the money market deposit accounts from a bank or credit union, but they're pretty darn close. They're still considerably virtual risk-free. If there's ever a default, other companies step in and bail out the investors with the blessing from the government, of course. You might hear the term breaking the buck. Exactly. When they lose money, it's like the whole world ends, and everybody jumps up and down and screams and hollers, and then the government comes in and says, okay, who can we find who will take over their deposit? No problem, another company, because the other companies don't want you to think that their mutual fund is next, their money market mutual fund is next. So the industry wraps their arms around them, and if the company's not insolvent, what they'll do is they'll go to the regulators and they'll say, oh, we goofed. Can we take money out of our account and put it in the account of our investors? Which is usually never allowed. You're never allowed to commingle your money with your clients. But in this case, the regulators say, okay, you goofballs. And so the last time this happened was, of course, during the Great Recession. So if you're interested in this, just type into any search engine, breaking the buck. And you could type money market first, but just type breaking the buck and you'll see examples of what happens when a money market mutual fund actually loses money. All check writing, they offer check writing privileges, transfer to and from your checking accounts, so they're just very, very convenient. Now, they don't normally pay as well as CDs, but usually, pretty darn good. So, slide number 66. Which short-term investment is for me? Commercial paper, bankers' acceptance notes. No, you and I are not going to do that. If you are, contact me. I'll be happy to help you. Savings bonds make cute gifts for newborns, but I don't think they're that big a deal. Many investors will purchase Treasury bills directly from the Treasury, and if you're so inclined, check it out. Well, you're going to do it for your assignment, and maybe you'll be hooked. And certificates of deposit, they're okay for those who are sure that they won't need the money until maturity. You're sure, right? Because if you do, they're going to penalize you. I think money market mutual funds, money market deposit accounts are the preferred choice for most savvy investors, especially just because they're so darn easy, and you don't have to worry about that CD coming due, or having to worry to wait until it comes due. You can get your money at any time. But I've talked with people who are definitely have not taken Business 123, and they sometimes will say, "Oh yeah, I got $200,000 in a savings account," and that banker is licking her chops. Why? Because they're paying them point whatever these days. Not much. I mean, it's going up, but so slowly. And they're turning around and they're lending that money at 18% to gumballs who have credit card debt. Oh, when you grow up, you want to be a bank, folks. I'm telling you, how do you know a bank is making money? The doors are open. Unless they get really, really stupid and start making very terrible loans like they did before the Great Recession. We'll talk about a different day, different lecture. Slide number 67, the emergency fund debate. Should you have an emergency fund? Well, this is a slide actually from Business 121. Many financial experts recommend that households create an emergency fund of 3, 6, or even 9 months of income. And you know what? I don't agree. Now, I'm not telling you should keep $17.87 in your checkbook. You should make some kind of cushion. But $25,000, $30,000, $50,000 in a savings account earning 0.1, 0.4, 0.5%, maybe 1% if you're lucky. Instead, I believe you should use the money to pay down interest, especially if you have credit card debt, because you can always run the credit cards back up again if you're in trouble. And you are adequately insured, right? You do have insurance. Yeah, I hope so. Now, there are some exceptions. If you're a salesperson, self-employed, you get laid off often, boy, do you need a hefty emergency fund. See, what happens is during the good times, people get into real estate or selling cars or whatever, and, oh boy, the money's coming in and things are going great, everybody's doing well, and they get used to that level of income. Yeah, they should be, right, they should be socking away a good portion of that because there's going to be a recession, we don't know when, and all of a sudden car sales just fall off the map and people aren't buying houses anymore. So, or they're holding off. So these salespeople get clobbered. Right, exactly. So if you're one of those people, you need a serious emergency fund. But I think it's overblown because it's all. You go watch the folks on the talking heads on the financial shows. They'll say, "Oh, do you have an emergency fund?" Yeah, whatever. Slide number 68. Okay, so here we are, folks, ready for checking for comprehension. What is a mutual fund that pools the capital of a large number of investors and uses it to invest exclusively in short-term securities? Oh, there's only one that has the word mutual fund in it, money market mutual fund. Again, you're going to hear people just say money market. Money market mutual funds and their counterparts at banks and credit unions have rates that are close to CDs, but they don't have the early withdrawal penalty. What are savings investments in which funds must remain on deposit for a specified period? There is normally a penalty for early withdrawal. That's a CD, certificate of deposit. Now, if interest rates are going down and you know you're not going to need the money, you can lock in a good rate, right? You can say, hey, interest rates are paying 4%, but they're going down, I'll do 4%. But you better hope you don't need the money until the CD matures, right? On the other hand, if interest rates are going up, you don't want to lock in your money for a long period of time, in my humble opinion. I'm not a big fan of CDs. So I'll tell you my biases right up front, okay? Just so we know. But that doesn't mean I'm right, folks. Everyone's different. Listen to the interview with Gene, my good friend Gene. What are short-term unsecured promissory notes, IOUs, issued by corporations with very high credit standing, normally sold in $100,000 denominations? The silly name is commercial paper. Commercial paper and their cousins, bankers' acceptance notes, are normally only purchased by institutional investors such as money market mutual funds because they just have millions of dollars to invest, and these things cost $100,000 a piece. And they don't want to just sell you one. They want to sell you a whole slew of them at a time. And number 71, what is a guaranteed demand account at a bank or credit union that normally pays little interest but will often be offered with a toaster or waffle iron, which makes it all worthwhile? A savings account. No comment. You grow up, you want to be a bank. Or maybe a banker, huh? Slide 72. And this is our discussion from Chapter 1. The introduction to investments. What is an investment? The overview of the investment universe. The eternal struggle between risk and return. Do you want to eat well or do you want to sleep well? And then our discussion of short-term instruments. So we hope you have had your interest piqued into investments and you are ready now to branch out and start peeling away the onion. Our first onion we'll tackle, our first concept that we will look at in detail, will be mutual funds. So we'll see you in our next chapter, Chapter 4, on mutual funds. Thank you for being in Business 123, Introduction to Investments.